Welcome back, guys. Let's wait for a few minutes so that others can join as well, and then we'll start. Good evening, Ritik. Good evening, Sora. So the yesterday's file, the file that we completed yesterday, where we left off, is being uploaded in the chat box. Did anyone try to match the balance sheet? Did anyone try to make the cash flow statement? Yesterday, we had two assignments. The first one was to adjust the income statement so that it accurately reflects the best case, base case, and the bear case scenario. And the second assignment was to try constructing the historic forecasted cash flow statement. Yes, everything is good, PP. I hope you are fine as well. For that AM, you will have to raise a ticket. The team will get in touch with you and they will give you a hand holding experience regarding the registration for JP Morgan internship. Good evening, KK. Sure, sure. I'll pass on the ticket to the right team and they will get in touch with you tomorrow. Okay, AM. Okay, let me. Today was the last day for JP Morgan. Today was the last day for JP Morgan internship. Uh, I'm unable to download the notes from LMS. You are not able to download the notes from LMS. Morgan ticket raised. Within 24 hours, usually the reply is received. Either you will receive a call or reply on the ticket within the next 24 hours, PG. And sometimes maybe on weekends, the team might take a bit more time to reply on tickets. But usually it takes less than 24 hours, and most of the cases less than 6 hours. If it is, uh, when will the JP Morgan internship starts? The internship phase starts at after the completion of fifth month of your training curriculum. Okay, shall we start? Actually, I won't be able to turn on the video. The reason being, I have a chat box which is only visible to me. And then, if I open the video as well, half of my screen will get blocked. So that won't make any sense. I won't be able to do the operations. So already, since there is a chat box through which I can see your chats, you might not see those chats, but I have a chat box over here through which I can read your chats while working on Excel as well. So that blocks half of the screen. So when I turn on the video as well, it will also block a portion of the screen. So that won't make any sense. So yeah, HP, you can share that suggestion through the ticket. Everything about placements and internships, you can raise a ticket about it. Let's start. Shall we start, guys? Shall we start with today's session? Yes, NS. about about all those things, please raise a ticket. I won't be the best person to answer on those parameters because I have never been associated as a part of the placement process. So it would be very hard for me to comment anything on it. So I would just say that raise a ticket. There is a different placement team who takes care of all this, and they will get in touch with you. Okay, shall we start? So we have an assumption over here. Now, first things first. So raise a ticket. Someone from the team will definitely get in touch with you, NS. Don't worry, don't get confused. Let's start. So, how can you adjust about this? How are you going to adjust this? In the other expenses over here is 17 to 89 and selling and admin expenses 0.00. So, how can we adjust this? What we can do is out of the proportion of 17 to 89, see now the EBITDA is 22873. Yes, the sheet was shared in the chat box thrice before starting. I think you are a bit late. Okay, for you, I'll try to upload it again. Just give me a second. Okay, okay, fair enough. So here EBITDA is 22,873.90, correct? Now we shall allocate a portion of these other expenses in selling and admin to reflect the values correctly. How we are going to adjust it? How we are going to adjust it? Let's see. So we will be taking average of the past years. We don't know what is the exact value of selling and admin because that selling and admin expenses are included in other expenses for this year. I don't know why Screener did this for this specific year. Sorry. It's revenue percentage of sales. So 10% of sales. Now, 13,825 is a part of selling and admin. Out of this 17,289, 13,825 is the part of selling and admin. So remove this impact of selling and admin. And at the end of the day, you will see our EBITDA didn't got changed. So we have rightly adjusted our selling and admin to reflect this year's value. Moving on. Now, what is happening over here is when we are changing the scenarios from a base case scenario to a bull case scenario or a bear case scenario, what actually is happening? What actually is happening is COGS, that is cost of goods sold, is increasing at a rapid rate, at a higher rate than revenue itself. So cost of goods sold being increased at a higher rate than revenue itself, increasing case one with the standard deviation, the cost of goods sold in a bull case scenario uh, is 75%, is not helping us to get a bull case scenario actually. So even if you will see in a first case, our net profit is 2000. In the third case, the net profit margin is around 6%. So after adjusting for selling and admin, we have rectified a bit, but to rectify it to a better extent, what you can do is change this again to 69 to cut this, paste it over here, cut this and paste it over here, or rather you can delete it as well, is equals to this minus standard deviation. Adjusting these two things should make up for the differences that we were getting yesterday. Now, in case one, which is a bull case scenario, 6% is our net profit margin. And in case three, that is a bear case scenario, the profit margin comes down to 1%. So the modeling part is at least correct. Now, moving on to the financial statements, where we are going to start with, our forecast for cash flow statement, and we are going to work on put our most of the efforts on matching the balance sheet. So this matching of balance sheet would be a checkpoint for you. If the balance sheet gets matched, all the efforts that you have brought up till here would be considered rightly linked, at least rightly linked. Okay, so let's start with matching the balance sheet. Profit from operations. We have our profit from operations. EBIT is called operating profit, but since EBITDA is a non-cash expense, we will add EBIT with depreciation and amortization and get EBITDA. So we are taking EBITDA as a proxy for profit from operations over here in case of the cash flow statement. Ideally, it should be EBIT plus depreciation and amortization, but here we are taking EBITDA because the screener format supports EBITDA. Okay. Now receivables. Always remember, guys, pay 100% of your attention. Pay 100% of your attention over here because this is really important. When evaluating liabilities, while evaluating liabilities, okay, first, when I am evaluating for 31st March 2025, when I am evaluating for March, year ending March 2025, no worries, K, no worries. But if the values are somewhat different, because I know it is not possible to track each and every step followed by me. If values are a bit different, it's perfectly fine. But make sure the checkpoints are ticked, the check boxes during the journey are ticked. One of those check boxes is that when you change the scenarios from base case to bear case, the profit margins should be reflected accurately. Okay. It need not be exactly the same, but make sure that in a bull case scenario, the profit margins are better as compared to a bear case scenario. Okay, so probably in that case, uh, you might not have dragged the formula in the future years. That might be one of the cases. So just go through the model, and in case you feel that you have any doubt, you can raise a ticket. We will see why this is happening. Fair enough. Now, what was I saying? Yeah. So while I am evaluating for March 2025, this becomes my current year. When I am evaluating for March 2025, this becomes my current year. This is my current year. Then what will be the past year? This is called last year. Current year and last year. Both of you, are you guys comfortable with both of these concepts? Last year and current year? Current year and last year. Okay. Please allow me to move forward if you are comfortable till this part, current year and last year, because this is going to be really important. While evaluating liabilities, yes, I am coming again. When we are evaluating, let's suppose you are modeling for March 2025. If you are modeling for March 2025, March 2025 becomes your current year, and the year prior to March 2025, that is March 2024 in this case, becomes your last year. So current year and last year. Similarly, when we will go for 2026, 26 will become my current year and 25 will become my last year. When we are evaluating from 27, 27 will become my current year, 26 will become my last year. Comfortable till here, everyone? Perfect. Perfect. Fair enough. Now, for liabilities, for liabilities, what we do is to to reconcile the cash flow statement. It means that to add values in the cash flow statement for the liabilities part, for the liabilities part, we do current year minus last year or previous year. While for the assets part, we do last year minus current year. For reconciling, we do liabilities. To reconcile liabilities, we do current year minus last year. For assets, we do last year minus current year. Now, I don't remember this usually. I get very confused while saying this, but in some of the tutorials, in some of the books, you might get this reference. So it was essential to just highlight the point. We are going to understand with this with a complete logical sense. We are going to understand this in a completely logical manner. So rather than following the cash flow statement, what we can do is follow the balance sheet impact and keep on reconciling the cash flow statement based on it. Now, equity reserves are same. Starting with reserves, in reserves, we have added net income and subtracted dividend. So we have our EBITDA with us. We have our EBITDA with us. Then we will have to subtract the interest expense that has been paid. So interest paid for financing activity is equals to minus, since this is a cash outflow, interest is an expense for us. It is a cash outflow. We are representing it in a negative sign. Interest expense, enter. Then we have taxes. So direct taxes paid is equals to minus of the tax expense. And finally, dividend has also been paid. So dividend paid is equals to minus of dividend. So these four adjustments we have made till now. We have subtracted the tax impact, we have subtracted the interest and dividend impact, and we are done with the reserves part of our financial statement. Next, going to borrowings. Borrowings have increased. Earlier, I had 118 rupees of loan in my books of accounts. Now I have 128 rupees of loan in my books of account. Have I raised debt or repaid debt? Guys, earlier I had 118 rupees of debt in my books of account. Now I have 128 rupees of debt in my books of account. Have I raised debt or repaid debt? Framing it in the other sense, framing it in other words, let's suppose I owed you 118 rupees by year ending March 2024. By year ending March 2025, that amount became 129, approximately 128, 129. Now, during the year 2025, during the financial year of 2025, have I raised debt? Have I taken more debt or have I repaid any debt? Raised debt, correct? Guys, are you getting this? Everyone, are you guys with me? Please ask me to repeat here itself if you are not getting this. The borrowings part. Shall I go ahead if you allow me? Yes. And according to the logic, if you remember what we discussed, more money is borrowed during the year, the amount has increased, the liabilities have increased. So that is a cash inflow for me. For liabilities, we have current year minus last year. For assets, we have last year minus current year. Yeah, in March 2024, the debt has been decreased. The reason being repayment has happened. Repayment has happened. That is why the debt has been decreased. If you can see over here, the repayment of debt has happened, and that is the reason being debt has been decreased. Probably company might hold enough cash. They don't need their debt anymore. The debt might get matured. Uh, the bonds that they issued might have been got matured. That is why they repaid the debt. Fair enough. This is our direct taxes. Now we are going to track the same formula for the future as well. Over here as well, we are going to track the same formula. Drag it here, and all the way that we have formulated our cash flow statement, I am just dragging the formulas. Now, moving ahead. KS, are you clear with your doubt? Shall I go ahead? With this, I am done with the borrowings part. Then I have other liabilities. Other liabilities was considered as a proxy for accounts payable. So the adjustments of other liabilities, we will be doing it in accounts payable. Now 32,138 and 29,598. These two are the values. Liabilities have increased. I have owed more. Proxy is just a substitute, representative. That is why we have used other proxy or substitute of payables, other liabilities as a proxy or substitute of payables. Now, why we did this? To make our model automated so that we can upload it on Screener and get it downloaded. So the whole companies, all the other companies, we just need to construct one model and we can download it for the other companies as well. Okay. Now, other liabilities. Again, current year minus last year, adjust it in payables is equals to current year minus last year. Next, with this, we are done with borrowings and other liabilities. Then we have our net block. In net block, in net block, I have to adjust for fixed assets purchased. Fixed assets purchased. So where I will get my capex from? Assumption sheet where we created our PPE schedule and where we have included purchase of fixed assets. Again, representing it in a negative sign because that being a cash outflow. So be comfortable with the sign, guys. Other assets have increased as well. Let me adjust this in other working capital items. Now these are assets. These are assets. My assets have increased. If my assets are increasing, whether it would be a cash inflow or a cash outflow. If I am purchasing more assets, will I be receiving cash or paying cash? When I am increasing my asset base, how come it would be NV inflow? If I am purchasing more and more assets, I will be paying cash, right? I will be paying cash. I am a customer now. When I purchase assets, when we purchase assets, we pay cash. So that would be a cash outflow, right? So based on that, it is last year minus this year. So if my assets are increasing, it should be represented in a negative sign in the cash flow statement. Are you guys clear about this? Yes, I am coming again. Let's suppose Rohit had, let's suppose Rohit, you had 1000 rupees of assets in year 2024. In year 2025, you had 1200 rupees of assets now. Ignoring the impact of depreciation, what is the amount of new assets that you have purchased? What is the amount of new assets that you have purchased during the year 2025? Rohit, what is the amount of new assets that you have purchased? Not in percentage terms, but in amount terms. Can I say you have purchased new assets worth rupees 200? You have purchased new assets worth rupees 200. Now, whether you have paid 200 or received 200, whether you have paid 200 or received 200, when we purchase, we get a cash inflow or an outflow. You have paid 200. So don't you think that should be represented in a cash outflow format? It should be represented in a negative sign is equals to last year minus this year. How will we get the negative sign? Subtracting a bigger number from a smaller number, we get a negative sign. So that is why last year minus this year will give me a negative sign. That's why I said we will understand this with a logic while ignoring this current year minus last year formula. Okay, we have our other assets with us. Next, we have our receivables. Receivables have increased. Again, assets have increased last year minus this year. Now I have given more credit to people. Inventory has increased as well last year minus this year. Okay, now the challenging part. Let's see whether our balance sheet gets matched or not. Where did we adjust it for borrowings? 3181.09, 215, 3181 total assets. Total liabilities are less than total assets. Our balance sheet is not getting matched. Now we will have to brainstorm it and figure out why does our balance sheet is not getting matched. Okay. Net block depreciation 35 191 13605 purchases of PPE plus depreciation, sorry, beginning minus depreciation plus purchases should give me the ending value, and it is accurately giving me the ending value. Purchases of PPE should be in negative sign. So here is a check line. The check line is assets minus liability. And since we can see that the asset minus liability is in negative sign, it should be zero like it has been for historical years. Since it is in negative sign, our balance sheet has not got matched. Profit after tax, EBITDA, we have added depreciation and amortization. The impact of depreciation and amortization has also been reflected over there. Net block. Let's try to figure out with net block. This minus this. Current assets have increased 7096, out of which this should be negative 7096 into minus 1. So this should be negative 7096. We want to get 7096 13605, and adding this with depreciation, we should get 7096. Yes, we are getting 7096. So we are clear about the net block part. Now, last year plus net cash flow. We had incorporated dividends paid, right? Did it got deleted? Yes, our dividend paid by mistake might have got deleted in between. So yeah, we have incorporated the dividend paid part. Now the final part is the borrowings. Borrowings have increased. So proceeds from borrowings is equals to this year minus last year. And yes, our balance sheet got matched. If you can see over here, our balance sheet got matched. Now, will we be matching balance sheet for each and every year? The answer is no. What we will be doing is simply applying the formula for future years. Alt ESF, Alt ESF, then function F4, function F4. Similarly, copy the formula, Control C, Alt S F, Alt S F, Alt S F, function 4, function 4, F4. Sorry. With this, our balance sheet has been matched. Any doubts with this? Guys, any doubts with this? Were you able to match your balance sheet as well? People who are doing this with me. Guys, are you comfortable till here? The balance sheet part. With this, our balance sheet has got matched. So just make sure if you are using the laptop to copy the formula, you will have to do Control C, Alt ES, or Control Alt V. Just open the paste special and then select formula, that is F. Click on enter. So that is, if you want to do F4, that is repeat what you have done previously. So that would be function F4, function F4. Okay. Now, in a DCF model, in a discounted cash flow valuation model, just give me a second, guys. Let me connect my pen tab. I have few things to discuss. Okay. So we are evaluating a DCF model, discounted cash flow valuation model. So out of various models used for the purpose of valuation, DCF being one of the primary ones. What is the idea behind this DCF? As the name suggests, it's discounted cash flow valuation. So the two main components of a DCF is discount rate, and the second one is cash flows. Now it's essential for us to match the right cash flow with the right discount rate. In terms of cash flow, we have two types of cash flows. Free cash flow to firm that we will be using to find the valuation of Maruti Suzuki. And then there is free cash flow to equity. Free cash flow to firm, as the name suggests, belongs to firm, not only to equity shareholders, but to the whole firm. The firm consists of both equity shareholders plus debt holders. Free cash flow to equity only belongs to equity shareholders. Now, if the cash flow belongs to the equity shareholder, the discount rate or the rate of return that should be provided to the whole firm should also belong to the equity shareholders only. And if the cash flow belongs to the whole firm, the discount rate should also belong to the whole firm. So the appropriate discount rate, the appropriate rate of return that we need to give to both equity shareholders and debt holders is weighted average cost of capital, that is WACC. All of you are done with the cost of capital part? No, some of you might have not. Okay. That is weighted average cost of capital. When we think about free cash flow to equity, the appropriate discount rate is cost of equity. Now, what is discount rate? Let's revise this. The discounted cash flow valuation is termed from a simple concept of time value of money, which says that value of the firm today, value of the firm today is nothing but the present value of future cash flows. Value of the firm today is nothing but the present value of future cash flows. So to find the present value of future cash flows, first of all, we need to forecast the future cash flows. So what could be the future cash flow? Let's say there is an investment which is giving you 100 rupees in the first year, 100 rupees in the second year, and 100 rupees in the third year. And along with this 100 rupees, you are also getting 1000 rupees extra at the end of third year, because at the end of third year, your investment is getting matured. So your cash flows would be 100 for the first year, 100 for the second year, and 1100 for the third year. Now these cash flows are future cash flows because these are standing in future. 1 year from now, 2 years from now, and finally 3 years from now. Now, if you want, let's say 12% return on these cash flows, if you want 12% return on these cash flows, how much investment shall you make today? How much investment shall you make today? To get that, we need to find the present value of all these future cash flows. To get that, what is the right amount of investment you should make today to generate 12% return on the cash flows that you will be generating in future? To get that, you will have to find the present value of future cash flows. So present value of future cash flows will be calculated using the formula future value upon 1 plus r raised to n. So what is this future values? These future values are nothing but cash flows. And what is this r? This r is rate of return or discount rate. Discount rate. Now, if discount rate is 12%, I can write 12% as 0.12, and this n is number of years. Try doing this with me for the first year, second year, and third year. What exactly is a cash flow? Cash flow is not profit. Cash flows are the cash generated by the company, or the expected cash that the company is expected to generate in the coming future. Cash that a company is going to generate in coming future. Exactly what is cash flow? Cash flows are the cash generated by the company through its operations, through its investment activities, and through its financing activities. After adjusting for COGS and other expenses, we get net income. COGS and other expenses are part of income statement, whereas cash, if you see, is a part of balance sheet. Yes, cost of goods sold and other expenses has impact on cash flows, but not the direct one. So let's suppose if COGS is 12,000, or let's say COGS is 10,000 million. Let's say the COGS is 10,000 million. So you might have taken goods on credit. Although the expense is 10,000 million, there is no certain cash outflow in this case. So cash flows are not directly linked to the expenses part. Cash flow same as revenue? No. How is cash flow different from revenue? If that is what I'm saying, how is cash flow different from revenue? So when you bifurcate revenue, you will get cash revenues and you will get accruals. These accruals are also called receivables. So trying to make you understand this in a very simple terms, let's suppose you have totally sold 100 million worth of product in a given year. Out of this 100 million worth of product, 80 million amount you have received in cash and 20 million is the credit that you gave to your customers. 20 million is the credit that you gave to your customers. So you will be receiving this 20 million at a later date. You will be receiving 20 million at a later date. So the cash that you have received for selling 100 million worth of goods is 80 million. But this 20 million incorporates the credit that we have paid, that is accruals. Now, why cash is more important? Why cash flows? So that is the difference between cash flows. The cash flows include this 80 million only, but the revenue part include the whole 100 million. Now, are you clear? Next thing, why are we focusing more on cash flow? Why are we focusing more and more on cash flow and not on profits? Because a rule of finance says, a term in finance says that the cash flows are difficult to manipulate. Cash flows are difficult to manipulate. Profits are profits are easier to manipulate. How? How can we manipulate profits, and how is it difficult to manipulate cash flows? Let me give you an example. Let's suppose I own a business, Maruti Suzuki. Maruti Suzuki offers you, Maruti Suzuki offers you to buy a car, let's say Nexa, at at $1 million. At $1 million, and the price of the car is $0.2 million in the market. $0.2 million in the market. The cost of the car for Maruti Suzuki is $0.1 million. Maruti Suzuki offered you to buy the same car which is priced in the market for $0.2 million. The cost of the car is $0.1 million, and the price that Maruti Suzuki is asking to pay you is $1 million. Will you be going to buy this car? Will you be going to buy this car? Are you going to buy this car? Something that is worth $0.2 million Maruti Suzuki is asking you to pay $1 million for it. That is what I'm saying. I am repeating that the price of the car is $0.2 million. It means that 20,000, or sorry, 2 lakh dollars. And Maruti Suzuki is asking you $10 lakh for it. Maruti Suzuki is asking you, let's say 10 lakh rupees for it. And the price of the car is 2 lakh rupees. Will you be buying that car? The answer is no, right? But what if Maruti Suzuki says you that pay for this car after 100 years? Pay this $1 million to me after 100 years. Now, will you be buying this car? Will you be buying this car? So, this $1 million, is what you will be showing in your revenue. This $1 million is what you will be showing in your revenue. Your COGS, cost of goods sold, is $0.1 million. And that will give you a gross profit of $0.9 million. But the profit is showing that the profit that is coming up to you is $0.9 million. But have you realized this profit? Have you realized this profit? Have you received the cash against this? The answer is no. You will be receiving cash after 100 years. So your cash flow statement accurately represents your earnings that you have not earned as of now, but your income statement can be manipulated. Your profits can be manipulated, and that is why this DCF valuation, that is discounted cash flow valuation, is carried out based on cash flows and not profits. Now, in our example, where we saw that in the first year, company is able to generate 100 rupees in cash, second year 100 rupees, and third year 1100 rupees. My question to you is, yeah, profits can be negative as well, but cash flow can also be negative for a given year, but the net cash flows can also be negative for the given year. So there might be some companies, who is in very early stage, that companies are experiencing losses. Does that mean those companies does not deserve any valuation? No, they have started the operation of the business, they have established the business, so that company also deserves the valuation. How the valuation will be derived? Various approaches are associated to it. Relative valuation approach, but then there is also a cash flow approach, where we will be predicting for first few years, although the company is generating negative cash flows, in the future years, if the company is able to generate positive cash flows, then we will be pulling back those future cash flows in present value terms and get the intrinsic value of the company, or the value of the company, target price of the company. Now, our cash flows were 100 for first year, 100 for second year, and 1100 for the third year. The rate of return that I want is 12%. So I want to find present value. I have future cash flows and I want to find present value. To find present value of future cash flows, we are going to pull back the future cash flows. And how do we pull back things? To pull something back, we divide. Divide by what? Present value is equals to future values. These are my future values, and we will pull back the future values by 1 plus r raised to n. Based on that, Based on that, what we will be doing. Let me use the Excel functions now. Year 1, 2, 3. In year 1, we will be generating 100 rupees. Year 2, 100. Year 3, 1100. Now, what is the amount that I should invest today to generate rate of return of 12%? I am going to use is equals to NPV. The rate will be 12%. And these will be my cash flows. And 951.96 is what I should invest today. Similarly, we are finding that a following company, let's say Maruti Suzuki, is going to generate cash flows for next few years. These are the cash flows that we are going to receive for the next few years as being the owner of the company. So what should be the price I should pay today for the company? What should be the right amount of investment that I should make to generate a given required return? Now, this required return for equity holders is cost of equity, and for the whole firm is weighted average cost of capital. Now, if we are deriving firm value by discounting FCFF, free cash flow to firm, with WACC, as I said, the right discount rate for free cash flow to firm is WACC. If we are deriving the firm value using WACC, the value that we come to is enterprise value. Whereas when we get FCF, free cash flow to equity, and divided by discounted by cost of equity, we get equity value. So what is enterprise value? Value for whole firm, value for equity as well as debt holders. Equity value is value for only equity holders. So what is the challenge? What is the next thing now that we want to focus on? We want to focus on to calculate the future cash flows and calculate that are the future. We want to get the present value, that is intrinsic value of these future cash flow. For that, we will need future cash flow. And in this formula, we will need 1 plus R raised to N, that is this R. And this R, since we are following the FCFF approach, will be WACC, weighted average cost of capital. Fair enough. Shall we start? If you are good with the concept, or do you guys need a break? Guys, shall we start calculating our FCFF, free cash flow to firm? Guys, please reply. Shall we start? Okay, I am repeating the last part. Our focus for now is in a discounted cash flow valuation. The two important factors are cash flow and discount rate. What makes cash flow and discount rate the most important factor? Because DCF works on the simple principle that the right price or should be price of the company or intrinsic value of the company is nothing but the present value of its future cash flows. So how we calculate present value of its future cash flows? By discounting it. That is why the name discounted cash flow valuation. And discounting it with what? A rate of return, that is required rate of return. Now, the cash flows and discount rate are of two types. The cash flows are FCFF and FCFE. These are the future cash flows. So if FCFF is the future cash flow, then discount rate will be WACC, weighted average cost of capital. If FCFE is the required cash flow, then cost of equity will be the appropriate discount rate. So that is WACC and cost of equity for you. Are you clear this time? AP, are you clear? Perfect. Next, we have to start with calculation on FCFF. Now, this is going to take some time. Even I need to take a couple of minutes break. Yeah, Rohit, that's what I'm saying. Even I need to take a couple of minutes break. Let me take a sip of water. Let me be right back with a fresh mind. And then we will start in the next couple of minutes. You can take a 5 minutes break and be right back on time. Take a 5 minutes break and be right back, guys. Thank you. Yes, yes, I have not done anything because I gave a break for a couple of minutes. I'm expecting people to be right back in meanwhile, so I'm not explaining anything now. So that is why the voice is not audible. Guys, please confirm if you guys are back so that we can start. Guys, please do confirm if you guys are back. Okay, let's start. Now, as I said, our next objective is to calculate cash flows, that is free cash flow to firm. Now, what is the formula for free cash flow to firm? Formula for free cash flow to firm is NOPAT, net operating profit after tax, plus non-cash charges like depreciation and amortization, minus capital expenditure, capex, or investment in, this is capital expenditure is also called as investment in fixed assets, or working capital in, minus working capital investments. Making these adjustments to net operating profit after tax gives me my free cash flow to firm. So why NOPAT? Coming to that, what is NOPAT? NOPAT, net operating profit after tax, is EBIT into 1 minus taxes. The question is why EBIT? Why EBIT? We are evaluating FCFF. FCFF. FCFF is free cash flow to firm. If the cash flows we are evaluating free cash flow to firm, we should evaluate on the basis of earnings. Firms is, again, please remember and always do remember, then when we talk about firm, it's both equity plus debt. So when we are talking about free cash flow to firm, it's earnings for debt holders as well as equity holders. And earning before interest and taxes, earning before paying any interest and taxes, belongs to both equity as well as debt holders. Interest being the component for debt holders and earnings being component for equity holders. That is why we are evaluating NOPAT based on EBIT, which is earnings available for both equity and debt holders. Why to add non-cash charges? Because these are expenses. These are expenses that we have shown in our income statement to get tax benefit. But these expenses are something that we have not paid. These expenses, we have not paid it to anyone. So these are non-cash expenses. Depreciation is called a non-cash expense. These expenses have not been paid to anyone. So we are adding back these expenses to check that what is the profit, what is the cash flow generating ability of the company. Now, when company has generated profit, we have added back the depreciation and we have got the cash flows. The company might have also invested on capital expenditure, investing on property, plant or equipment. So to understand or remove the cash outflows that has been occurred due to investment in capex or investment in fixed assets, we are deducting capital expenditure. Apart from capital expenditure, company might have also spent the amount on purchasing inventory or paying or buying other current assets. Some of that part of buying other current assets might have also be funded by current liabilities. So what is working capital investment? Current assets minus current liabilities. So let's suppose 100 rupees is the inventory that I have purchased. 100 rupees is the amount of my current assets, out of which my supplier gave me credit of 80 rupees. So what is the amount that I have invested in my working capital from my own pocket? That is 20 rupees. So this 20 rupees is my investment. This is the cash outflow that has been gone from my own pocket. And that is why we are excluding this working capital investments. Making all these adjustments, we come to free cash flow to form. Clear, guys? Are we guys clear with? Are you guys clear with free cash flow to form? Shall we start constructing free cash flow to form? Perfect. Now I want to take a format. What we are calculating over here, net operating. So we will be finding out all these elements one by one. First, net operating profit after tax, depreciation we have capex, and then we will try to find working capital investments. Net operating profit after tax. That is no PAT. Copy. Let's just do this. Copy Alt TST, Alt TS, L, Alt H, Y. If you are practicing this on the weekdays, you might be comfortable with these concepts, the shortcut keys that has been extensively used in the class. Operating income, which is my EBIT. Then I will have an effective tax rate. Based on that, I'm going to calculate my tax expense. And finally, I will be having no PAT, net operating profit after tax. For this, I will be using this format. It's essential to keep your format consistent throughout the model. First, starting with EBIT. This is EBIT. Drag this formula. Effective tax rate. I have my effective tax rate as this one available to me. Just a second. In assumption, we are getting effective tax rate around 23%, 22 and 21. Then why effective tax rate over here is 14%? Is our net income getting matched? We will have to see this, guys. Correct. 3188 divided by 13706. EBT is different. How come this is possible? Believe other income was subtracted. In case of, oh, I'm sorry. Yes. In EBITDA, we subtracted other income. Ideally, other income should have been added. And yeah, now this is correct. So guys, yeah, 23,557, 2357. So yeah, these are small things that you should take care of. Ultimately, the models are so much interconnected that you will be able to spot it, but make sure when you are able to spot that, you should, thanks GA for helping me out, you should be able to figure out that where the discrepancy is coming from. Effective tax rate. Now, how I got to know that we have made an error. Here, we were getting effective tax rate as 12%, 13%, 14%. So what I thought is how could effective tax rate directly fall from 23% in a 23 or 25% range to directly 23%. So that was the uh, moment that I spot that we have made an error. FCFF. This is operating income. We are going to drag this tax expense into effective tax rate and net operating profit after tax, EBIT minus taxes. If you would have implemented the formula, EBIT into 1 minus tax, you would have got the same value. Next, I will need my capital expenditures. Copy this, Control plus. We got tax expense by multiplying effective tax rate with EBIT, earning before interest and taxes. Now let me just do some editings. Okay, we want capital expenditure. Capital expenditure is equals to minus. We have made a PPE schedule specifically for this purchases of PPE. So for first year, although we don't have, we have our capital expenditure available with me. If you don't want to keep it negative, you can not keep it. It's fine if you don't want to keep it negative, but make sure while adjusting, you subtract it. Then we have net working capital calculation. Now, how I am getting that I want net working capital? Remember this formula. No PAT, I am done with no PAT. I already have my depreciation. I don't want to calculate depreciation separately. I am linking my capex and finally going to working capital investment to get my FCFF. Net working capital calculation. Net working capital calculation. Fair enough. Net working capital is current assets less current liabilities. Current assets less current liabilities. For now, I will need my current assets. These are my current assets. Then I'll need my current liabilities. Since other liabilities is being included in current liabilities, take that. Finally, I will have working capital. Negative working capital business. Very insightful. It would mean that your suppliers are funding your working capital requirements. This is generally a moat. Generally, in those businesses that has a very high barriers to entry. What I mean when I say that has very high barriers to entry, it means that there are firms in the industry, there are many suppliers in the industry, and the when it comes to choosing the raw material, we as a business house has the pricing power. So generally, what suppliers do is give better credit terms to their customers. On the other hand, when I am making the sale to my customers are paying me in cash. So that makes my business a negative working capital business, a business with negative working capital requirements. So I don't have to fund uh, working capital from my own pocket. Now, this is working capital, but I need working capital investments. So working capital, current assets minus current liabilities, as I said in current assets, what we do last year minus this year. So what is our working capital investments? Working capital investment is equals to last year minus this year. Okay. Next, I will be going for my FCFF calculation. First, NOPAT adding depreciation I will get my gross cash flows. FCFF is free cash flow for free cash flow to firm. Free cash flow to firm calculation. NOPAT plus depreciation. Also, one thing that you should ideally take care of is linking the right year numbers with the right year numbers from the financial statements. Gross cash flow. We have our gross cash flow less fixed capital investment or called capex is equals to minus of this, and then working capital less working capital investments. Since it is an investment, it is a cash outflow. I'll keep it in a negative sign. Okay. Finally, free cash flow to firm. Control C or TST. Sorry. Since we have already included the negative sign, we are just going to add it. Since we have already included it in the negative sign, we just need to add it. If you want to make it subtract it using the formula, you don't need to put that negative sign. Is equals to gross cash flows minus this. These are our free cash flow to firm. Now let's take care a bit about the editing part. These years representing the future years. Okay. These years also being future years. Each of these having two decimal places. Over here as well, let's adjust this to two decimal places. Perfect. Some options are in two decimal places as well. FCFF are in two decimal places. This just makes your model look consistent and gives a positive impact to the reader. With this, we are done with the free cash flow to, we are done with calculating the free cash flow to firm. The next thing that we will go for is the right discount rate. So this will be our DCF sheet. Or WVG. Guys, do you have any doubts in free cash flow to firm part? See, while doing that, a blunder happened. Again, we will have to change this to date. Just give me a second. Let me just change this date. Perfect. Here it seems to be perfect. Again, here we need to change it. Fair enough. Any doubts in the modeling part till here? Please let me know. Now we are moving with discounted cash flow valuation part. Alt H MC. Discounted cash flow valuation. Let's make it dynamic this time. Discounted cash flow valuation for Maruti Suzuki India. Okay. Perfect. Now, now we want to work on discount rates. Guys, now we want to work on discount rate. What is the right discount rate for FCFF? Since we have calculated FCFF, what is the right discount rate for FCFF? The right discount rate for FCFF is WACC, correct? The formula for WACC is weight of debt into cost of debt into 1 minus taxes plus weight of equity into cost of equity, weight of equity into cost of equity. If preference shares are available, we would have considered preference shares, but there are no preference shares available for this company. For that, we will need to check the balance sheet. Can we see any preference shares over there? No. So this is perfectly fine. weight of debt into cost of debt into 1 minus tax rate, weight of equity into cost of equity. Now let's try to figure out the formula of each and every line item one by one. Weight of debt would be, for weight of debt, we will be doing debt by total capital. Then we have cost of debt, interest expense upon debt will give me my cost of debt. Weight of equity will be equity divided by total capital. So what does this weight of debt and weight of equity says us? This says us that the percentage of debt or equity, what is the percentage of debt or equity in total capital. Weight of debt, cost of debt, weight of equity, and finally cost of equity. Cost of equity is RF plus RM minus RF into beta. RF plus RM minus RF into beta. Now, this model of finding out the cost of equity is called CAPM, that is capital asset pricing model. Capital asset pricing model. Now, there are some assumptions that we need to make to find this required cost of equity. Those assumptions regarding RF, RM minus RF, and beta that we will take would be known as valuation assumptions, because we are making these assumptions to value the company. So these will be known as valuation assumptions. Alt HMC. Now, what all valuation assumptions do we need to make? First is, just give me a second. Let me just copy a format, an appropriate one. Okay. So valuation assumptions, growth rate, this growth rate is growth rate for terminal value. We will come to what is terminal value in some time. Then we will need risk-free rate. Risk-free rate for what? For calculating cost of equity. As we saw over here, we need risk-free rate, RM minus RF. What is RM? Return from market. RM is return from market. And we want beta. We will calculate beta to keep it simple for now from regression approach. Although there are various approaches of calculating beta that is extensively covered in cost of capital part. Now, we also need to highlight the sources from where we have taken these assumptions. We need to highlight the sources from where we have taken this assumption. So first of all, I will keep growth rate as it is for now. I won't tweak anything with the growth rate part because I am assuming that I have not discussed anything about the growth rate till now. I have not assumed. I am assuming that I have not discussed anything about the growth rate till now. What I have discussed about the discount rate is that we are calculating FCFF. I am revising. FCFF is discounted using an appropriate discount rate, that is weighted average cost of capital, weight of debt into cost of debt into 1 minus tax plus weight of equity into cost of equity. For weight of debt, cost of debt, 1 minus tax and weight of equity, all these items can already be calculated using the available data. But when it comes to cost of equity is calculated using CAPM, capital asset pricing model. And the formula for cost of equity is RF plus RM minus RF. That is, what is RF? RF is risk-free rate. What is risk-free rate in India? The yield on government bonds, yield on 10-year treasury bonds is the risk-free rate, or sovereign government bonds. Treasury is used in US perspective. That is why I'm saying sovereign bonds. RM is return from market. RF is risk-free rate. And then there is beta. So we want all these elements. We will try to hunt for all these elements one by one. So let me just share my entire screen. Now, I want to search for 10-year, yield on 10-year sovereign government bonds. So the current yield is, according to worldgovernmentbonds.com, that seems to be a reliable source. The 10-year government bond has a yield of 6.940%. So for now, I am just keeping it as it is. I am just giving the source. Let's check whether this is good. So yeah, this is the website that we have followed for risk-free rate. Okay, sorry. This was not for the government bond. This is for the risk-free rate. As I said, we will keep uh, growth rate for terminal value as it is for now. We will see to it later when I will discuss the concept of terminal value. This is risk-free rate. Then I have RM, total return. RM is return from market. The market index represented in India is Nifty 50. So total return on Nifty 50, and by total I mean average total return on Nifty 50 in last 25 years. It's around 14.2 CAGR. This is from NSE India itself. So 14, what was the value? 14.20 percentage is my return from market. Let's check whether this is where this is leading us. Okay. We will just give the link for NSE website. That would mean NSE is the source behind this. Okay. Next, beta. Beta is something that we will be calculating current market price. We have that in data sheet. Current price is 12,104. With this, we are done. Beta is something that we need to calculate. So we are going to make a new sheet named as beta regression, alt HOI, sorry, alt WVG. What we will be doing is CMP is current market price. Current market price that we have taken from the data sheet. Alt MC is equals to beta for Maruti. Okay. We are just making it dynamic so that when we upload it on screener, first of all, we need to download two sheets. We will go to Yahoo Finance. Open this. Search for NSE India or just Nifty, sorry, not NSE India, but Nifty, NSCI. Yes. In this, we will go to historical data, locate to historical data, arrange this based on historical prices weekly, and the data that we are going to select is of last 2 years. So today is 28/7/2024. We want to make it to 2024. 22. 2 years. Weekly data is available with us. We will be downloading it, and I have the file available with me. Similar, India as well. I will go to historical data, set it to weekly historical prices for last 2 years, and download it. These two files will be available for you as well. Alt H O I. Make sure that it is in the descending order or ascending order. Next. Open the sheet of NAC. Make sure that this is in ascending order as well. Now, the dates should ideally be same. So, we will take dates, adjusted closing price of NSC, adjusted. I know, guys, this might seem to be a bit boring for you, but yeah, this is what analysts usually do. It it is the need of the hour. This is the phases of the curriculum, the interesting part, the somewhat boring part, but we will have to sail through all this. Adjusted closing price for NSC is equals to, again, open bracket, adjusted closing price. Now, why we are choosing adjusted closing prices? Adjusted closing price incorporates the impact of dividend as well, and the impact of dividend in the impact of dividend while calculating beta is essential. That is why we are choosing adjusted closing price. Sheet 1 data sheet. Go to Maruti Suzuki India. Yeah. Alt H O I. Now dates. These are dates. Control C. Alt S. V. Alt H O I. Now control 1. Date. Just choose any of the format of your choice. If the format is not available, you can use a custom date. Use DD, YYY. So this is the date, adjusted closing price of NSC. Make sure that you are on NSC, Excel sheet, adjusted closing price, Control C, Alt S, V. Similarly, you need to make sure that you are in adjusted closing price for Maruti Suzuki, Altis, T, Altis, V. So now give a center alignment to it. Okay. What is the shortcut for copying the column? So you need to select, go to the first column, first row or the or first cell of the column, Control Shift down, Control C. What you need to do is Control Shift down and Control C. Then adjust this using the format Alt HOI, Alt HOI. Okay. Next, give it a center alignment. Control 1. Go for borders. Add these borders as well. Perfect. Now, the formula for beta is change in stock upon change in market. So we will be using slope coefficient for this. Known wise, y is my dependent variable. Since stock is dependent on the market, so I will be using y. Then known excess. This is called regression. One of the most important segment of finance, that is called quantitative mathematics, deals with this. 0.6241 is the beta coefficient of Maruti Suzuki. Now, beta has a tendency to regress towards 1. So we will be drifting this beta towards 1. But since I think this is getting very heavy for all of you, so I will stop it over here for today. We will be continuing this. Same thing. We will be continuing from here in the next class. So I hope you might have found this session a bit boring. Yeah, I am putting that note, Shift F2, slope is equals to, yes, I will be sharing the sheet. Wait for a second. Beta is change in stock divided by change in market. Change in stock upon change in market. Slope function is used where y is independent, sorry, y is dependent variable, stock in our case, x is independent variable, which is market. Okay. So with this, we are done. Wait for just 1 single second. Let me just upload the sheet in the chat box and then we can take leave. Yes, beta for the market is always 1. The reason being change in market divided by what is beta? Beta is any given entity divided by the changes in market. So change in market divided by change in market would be 1, right? So that is why beta of the market is always 1. Anything divided by itself is 1. That is why the beta of market is always 1. Just wait for a second. The sheet is being uploaded. In the next class, yes, Arjun, I agree. So you might have found this a bit tiresome, but guys, this was the need of the hour. This is the part of the curriculum, and we need to deal with this. Although once you will master this part of the financial modeling, we have a lot to cover in the coming time as well. We will be making M&A and LBO models. We will be making relative valuation models. We will be also going for the startup valuation models as well. So there are still a lot of things to learn. Stay attentive in class. Also do practice during the weekdays as well. So this was all from my side, guys. I hope you enjoyed the session. Probably might you have feel that this session was boring, but still be in touch with the curriculum. And that's all. Thank you. Thanks a lot. It was very wonderful interacting with you. Sure, PP, sure. Thank you, guys. Thanks for your wonderful response. Thanks for the positive feedbacks as well. Good night, guys. Bye bye. See you guys next week. Have a great week ahead.